This is the FM Gold channel of All India Radio. In the program News Analysis, now we bring a discussion on RBI monetary policy. The participants are Faranjoy Guhar Thakurta, economist, and Prakash Chawla, senior economic journalist.
Against expectations of interest rate hike at least by 25 basis points, the Reserve Bank of India Governor Raghuram Rajan has really surprised the market as also the industry in a pleasant way that he kept the policy rates unchanged. And he himself said that I am taking some kind of a calculated risk because so far the inflation is concerned, November figures were before him, December figures are yet to come, and the governor himself said that by his own survey and assessment there were indications that the prices of vegetables and fruits are softening. And to that extent he thought, why can't he wait unless he takes a call on the interest rate hikes? So he took kind of a calculated risk, but his critics are saying that has he not really gone too far in the wake of high liquidity in the system and inflation still remaining very stubborn at say 11.25% at the retail level and at the WPI level itself 7.5 with vegetable and fruit prices remaining really high. So how do you take this policy? Do you think he has really taken a risk, and do you think that he has somewhere put the issue of inflation on the back burner?
The governor has indeed taken a risk, and by his own admission he says he has taken a risk. You are absolutely correct. What we saw, the November data on the wholesale price index, and in particular the consumer price index, has seen a sharp rise, which Dr. Raghuram Rajan describes as has an element of noise. I don't know what he means by it. He said there's an element of noise. What we really see is that the consumer price index has gone up from 10.17% in October by about 1 percentage point to 11.2%. Now this is very, very high indeed. And within the consumer price index, you see food inflation at 14.7%. And within food inflation, you see the vegetable inflation component at very, very high at 61.6%. Now, it is absolutely correct that vegetable prices tend to come down in winter because supplies go up. And what Dr. Raghuram Rajan is arguing that he is going to wait for the next round of data, and that he says the RBI should not be reacting to every round of inflation data. Now there's a risk involved in it because he himself, after taking over charge in September on 2 occasions, had increased the short-term repurchase option rate, signaling a hardening of the overall interest rate regime. Whether this is a Christmas gift or a New Year gift, he has kept his options open. The next review of the monetary policy is scheduled for the 28th of January. But roughly 2 weeks prior to that, you're going to get the inflation data for December. And if that data does not show a softening of food prices, in particular vegetable prices, and the inflation rate in general, he has kept the option open for increasing the rates
again, yeah.
Suddenly. And to quote him exactly, he says, if the expected softening of food inflation does not materialize and translate into a significant reduction in headline inflation in the next round of data releases, or if inflation excluding food and fuel does not fall, the Reserve Bank of India will act, including on off-policy dates if warranted, so that inflation expectations stabilize and an environment conducive to sustainable growth takes hold. So in other words, he is himself saying that there is a risk involved in not doing anything, as he has at this particular point of time, and that he's just waiting and watching. And he himself, in his interaction with journalists, said that this was a very, very, very close decision because current inflation, he acknowledges.
He also talked about the weak state of economy. And suppose he also mentioned about that if in case he had gone in for the rate hike, then there could have been a kind of a charge against him that what he calls inadvisability of overly reactive policy action. There was a policy decision as a close one, and he took a calculated risk. But then the risk also involves, as he himself said in the policy paper, that the volatility in the financial market has receded, but it could come again following the expected US tapering, which has happened now. So to what extent you think this volatility in the financial markets could be seen again, or do you think that the markets have already factored in, and as the Finance Minister P. Chidambaram has said, that government is almost prepared for this? It was almost inevitable that's going to happen because the indications were coming from the Federal Reserve.
There are 2 or 3 points to be made in this context, and these are very, very important issues. You see, when in August, there was merely an indication from the Federal Reserve that there would be a tapering of the quantitative easing. That is, the rate at which the US Federal Reserve, the central bank of the government of the United States of America, purchases bonds, which means it imparts liquidity into the system, roughly to the tune of about $85 billion a month. Now, cut of $10 billion a month is a sharp cut. And you may not acknowledge...
You think it's a sharp cut? People are saying it's tapering light, people as you call it?
Well, that's a matter of perception. If it was down to 5, from 85 to 80, I would say that was around expectation. From 85 to 75, to me, is a little higher than expectation, and there's a little more than tapering. It's a cut. So, how the markets will react? Time will tell, but I will not be surprised if the reaction is a little adverse. Perhaps not as adverse as you saw in August, where you saw the value of the rupee coming down more than the values of other currencies of other emerging markets and emerging economies. And that was also because that was a time when we had a very, very high, unsustainably high current account deficit. Thereafter, the government has imposed a number of curbs on imports of gold and increased the customs duties as well, as a result of which we have seen the current account deficit as a proportion of GDP coming down. It's not as high as 5% or over 5%, and the government hopes to contain it below 3%. Whether it does so, time alone will tell. I do expect an impact. I don't think it's going to be a sharp impact. If you recall, at one point of time, there was the expectation that the rupee might weaken to almost $70.
To what extent do you see impact of this development on the stability of the foreign exchange rates?
If I see the rupee weakening, as I expect, now this has an impact on the domestic economy, notably because we are importing 80%
No, you're right, but to what extent you expect impact on the rupee?
See, right now it's 62 rupees to a dollar.
That's right.
I won't be surprised if it weakens to say 64 or even 65 in the next few days. I won't be surprised. But I can't predict this. It's a very difficult call to take because it depends on a whole series of factors, including how much people have factored in. People are expecting, people have been expecting a tapering. Some people were expecting this tapering in the new year. It's happened a little ahead of schedule. Some people will say...
The scheduling is new year. The announcement has been done now.
Correct. So the announcement was being expected later. Let me put it this way.
Right.
It's difficult to predict the market, but I really think what's going to happen, there's going to be at least a slight weakening of the rupee vis-a-vis the dollar.
But then, when you say 65, our current account deficit seems to be well under control.
Okay. The issue is not so much in this case the current account deficit. As I mentioned earlier, because of various steps taken by the government, we have been able to some extent control that. The ballooning imports of gold have not happened. But I think the important issue is somewhere else. It is because India is importing 80% or a little more than 80% of the country's total requirements of crude oil. Now, when you pay for this crude oil in rupee terms, it puts a huge pressure on the oil companies, and the pressure is there to increase diesel prices. Once you increase diesel prices, it has a cascading effect on the prices of a wide range of articles of mass consumption because diesel affects the cost of transportation. Now, all of this is going to happen at a time when India is gearing up for the next round of general elections. The 16th general elections will probably begin in the month of April 2014. You're not going to have another union budget. You're only going to have a vote on account. So this is happening at a time when there's considerable amount of political uncertainty. So in that sense, you're seeing also a situation which is very, very volatile. And I mean, one would always hope that you don't have a situation of the kind that you had some months ago, but it's really a very, very difficult call to make, especially in the context where industrial production has also slowed down. And you must remember that one of the reasons why the Indian economy has not done as very badly as many people had expected is because we had a good monsoon and agricultural production is expected to grow by about 4%.
But when we talk about inflation, we all tend to look towards RBI as if RBI has some kind of button that gets pressed, the inflation will be over. Part of the responsibility or a large part of the responsibility for inflation management lies on the central and the state governments, as was highlighted by Governor yesterday while he was talking to journalists. And that involves fiscal consolidation, fiscal discipline at the central level and supply management at the state level. And kind of steps that the government has been taking and the finance ministry has been taking, Governor himself had indicated yesterday that would involve cut in expenditure.
You are absolutely correct. Inflation is a very, very complex phenomenon. In the Indian context, it's particularly complicated. Inflation is on account of a variety of reasons, not one. It's a combination of circumstances. You have already pointed some of these out. You are seeing supply bottlenecks. That's one, especially as far as various agricultural products are concerned. That's one part of the story. The rise in rural wages on account of various reasons, including the Mahatma Gandhi National Rural Employment Guarantee Program. And so what I'm saying is that inflation has been the single biggest economic problem that has proved to be very, very difficult for the government to tackle. Remember this high inflation that we are seeing today. It's not happening today. It's been continuously happening for the better part of the last 6 years in a row. It's never happened in Indian history before that you've seen 6 years of 10% consumer inflation according to the government's own data. And this is happening at a time, as you say, there's political uncertainty, elections are around the corner. So all of this, as you say, if there's a cutback in expenditure, say the finance minister wants to keep the fiscal deficit not at the budgeted target, what would this mean? We are already seeing news reports saying other ministries are very unhappy that they are cutting down expenditures on various social welfare schemes, including the Pradhan Mantri Gram Sadak Yojana, including various social welfare programs. So, if you want to cut expenditure and you want to cut plan expenditure, you want to cut down on welfare schemes, this is all going to be politically very, very difficult in an election year. And also in terms of economics, all of these will have very contradictory impact. Say for instance, the dilemma of the Reserve Bank of India. And if you want to control inflation, and you look at the classical theory that you don't want too much money chasing too few goods, then you have to hike the interest rates. And if you harden the interest rates, that in turn will impact investments. And if you don't have investments, that in turn will result in a slowdown of the economy. The rates of growth will come down. So we are dealing with
In fact, Governor yesterday said that I keep hearing so-called supply constraint. He said at the end of the day, if the supply constraint is there, we all know. Then to that extent, the demand has to be calibrated so that the mismatch gets narrowed and then somewhere match is found.
This is all easier said than done. And let me point out two specific examples in the recent past where we see this dilemma. We've had overproduction of both onions and sugar. We've allowed exports of these items. But by the time exports have been going on, the shortages have developed in the following cropping season. So we've had a curious situation where we've been exporting and then we are importing the same product, often at a higher prices. Now this is one example of managing food supplies, which is not easy in the best of times, but the impact is on inflation. The impact is on the common person. So these are very, very difficult issues, and I must say, this is really the biggest challenge before us.
There have been suggestions by some eminent economists, and obviously other people have also been saying that why can't the government really offload the kind of stock of food grains really lying, almost rotting? You can really flood the market in a way and will calm the prices.
There are two aspects to this problem. There is a popular misconception about food rotting in our godowns. I'm not saying food is not rotting. I'm not saying rats and rodents are not eating. But if you go by the official figures of the Food Corporation of India, it's not as high as...
They are only giving 1 or 2%.
They are saying that it's very... Their figures say it's negligible. Secondly, the issue is really not so much of cereals. If you look at the last 6 years, yes, cereal prices, rice and wheat, have gone up. But the real increase in the food inflation has been not on so much on rice and wheat. It has been on vegetables, in poultry, in fish products, in dairy products, edible oils. So these have been the problem areas.
To sum up this discussion, I would say that the inflation management really is a wider phenomenon. It should be really done not at the RBI level or maybe at the finance ministry. It has to be really somewhere the other ministries like consumer affairs. You need to really check, as somebody was suggesting, that why don't we have a kind of a alarm situation, like early warning signals when you know that the production of such and such item is not going to be up to the mark. It really needs the inflation management strategy the country needs.
I agree 100% with what you said. Once upon a time, I don't know whether it's still active, there used to be a cabinet committee on prices.
They don't seem to be very active. They hardly meet.
The issue is really absence of coordination. As you have rightly pointed out, you have a Ministry of Food and Civil Supplies, you have a Ministry of Consumer Affairs, and Mr. Sharad Pawar once was also holding these two portfolios. Now it's with Mr. K.V. Thomas, and you also have Ministry of Agriculture. But then you also have to bring in the Ministry of Finance, the Ministry of Commerce.
Let's hope these all ministries put their head together.
Absolutely.
And really try to solve this problem, because the consumer, ultimately it is the consumer and the common man who suffers the most.
At the end of the day, it also has an impact on the politicians in power.
Thank you very much.
Thank you so much.
You are listening to a discussion on RBI monetary policy. The participants were Faranjoy Guhar Thakurta, economist, and Prakash Chawla, senior economic journalist. It came to you in the program News Analysis, produced and presented by the News Services Division of All India Radio. This program is also available on our website, newsonair.nic.in. You may email your opinion about this program at airnsttalks@gmail.com.